All right, warm welcome to a brand new week ahead, everyone. I hope everyone had a great weekend and rested well. Let's quickly take a look at what we have in store for us for the week ahead. I mean, last week was just so massively complicated by the US government shutdown. That completely complicated things. It meant that we didn't get any of those key US data points, especially the likes of the NFP that we were waiting for. It also means that it complicates things for both the markets as well as the Federal Reserve. Remember, these guys, they need the employment data in order to make up their mind about what they have to do about interest rate policy. So the fact that we didn't get those key economic data points, especially NFP, it just super complicates everything. Now, when it comes to government shutdowns, usually they're short-lived, and the markets don't really pay much attention to them. And to be fair, if you take a look at how markets traded across the board last week, I would say for the most part, markets have been able to just push it aside and didn't really pay much attention to it. There wasn't a lot of market reaction on the back of the shutdown. But there are a few analysts who argue that maybe this time could be different. I mean, at the moment, if you take a look at US politics, the polarity and massive division that we have between the two political parties, it's grown to crazy intense levels, right? And currently the main opposition or main issue that they have with the shutdown is arguments about healthcare subsidies. That's one of the major stumbling blocks at this stage. And normally when you have these shutdowns, there's talks of potentially furloughing federal employees. But right now, the Trump administration is, they basically coming out talking about straight up layoffs for many thousands of federal employees. So even though markets normally rightly look through these types of situations, and I really do hope that it's a short-lived thing, even though that's normally the case, it can spill over into something a little bit more ugly, right? The other problem that we have here is time from a market's point of view. As long as the government shutdown is in play, we won't get any data that is released by US government agencies. Think of things like obviously Friday's NFP that we didn't get. What about the next CPI release that we need? The PPI, the PCE, what about claims data, retail sales data, durable goods data? The list goes on. So without those key economic data points, it's very difficult for the Fed to know where the economy is tracking, right? They're basically flying blind into policy decisions, which isn't positive for anybody. Not only that, if you take a look at the website here from the CFTC, we're not even getting CFTC positioning data. Right. So it just, like I said, it overcomplicates everything. It's such a pain in the ass, but it's something we'll just basically have to stick through until it's resolved. There's a couple of possible outcomes. Obviously, we're hoping for either one of the two sides to crack and find some type of compromise. Right. That'll be the first or best case scenario. But if it carries on, eventually the longer and longer it goes, the more and more negative that could actually spill over into the US dollar. It'll probably impact the dollar first, and then eventually it could spill over negatively into things like equities as well. I mean, again, for the most part, we didn't see the market respond too much to that, but it is something that can be aggravated. I mean, let's take a look at some of the broad moves we had across the board. We did see a little bit of a pullback in the US dollar, to be fair, but a lot of that, I think, was just purely not necessarily down to the shutdown itself, but just down to a little bit of mean reversion after what was a very solid rush to the upside the week before. The position that I had running, the remaining position at least that I had running in the pound dollar, that was taken out at break even. We were able to take some profit on those first initial moves to the downside, but the remaining unit that was at break even was taken out at break even, and currently still holding on to one position each for the dollar CAD as well as the dollar index. I'm basically just going to let these run and see how it plays out. Like I said, hopefully the shutdown, just like all the other shutdowns, is short-lived and we don't have to worry about it. But the risk is that it does spill over into something a little bit more ugly this time. And obviously that could eventually lead to more negative flows coming into the US dollar. If that is what takes me out of the trade, then so be it. But I'm not going to be getting out of these positions just purely based on the shutdown. We'll see how it happens. And again, even if those remaining units do get taken out, they will be taken out at break even. So I'm not really going to break a sweat on the back of that. We'll just play it out and see how things progress. Now, in terms of other markets, I mean, metals once again solid week. Gold trading just shy of all-time highs once again, very close to 3,900 level. Silver also finished the week very close to all-time highs. Solid rush there to the upside for both of those two markets. Copper also had a beautiful run to the upside. That wasn't really driven by the same drivers that we would associate with things like gold and silver. On the copper side, it is all just down to supply. We had news on Wednesday from Freeport McMoran. Now, they are obviously one of the biggest mining companies. They declared a force majeure at Grasberg, which is one of the biggest gold and copper mines in the world in Indonesia. And as a result of that, there's some speculation that their supply going into 2026 could be down as much as 35-40%. So that gave a big rush to the upside for copper. We'll see how far that one can squeeze. I mean, we're still recovering after that huge push we had to the downside back in August. We basically made up about halfway of that initial drop. Not really something that I'm keen on trading myself, but important to know the reason for that move that we had to the upside. In terms of oil, massively pressured last week, mainly also on the back of supply demand concerns. We obviously had expectations of a pretty sizable increase in or reduction, if you will, in production curbs from OPEC. There was some comments saying that the announcement that we were expecting or was expecting over the weekend could potentially see production curbs being reduced by 250, some even saying 500,000 barrels per day. That obviously weighed on oil prices. However, we just got news about 20 minutes ago from doing this recording that the 8 main members of OPEC actually reached an agreement, and they're only looking to implement production adjustments of just 137,000 barrels per day. So there could be a little bit of a gap to the upside there for WTI coming into the open on Monday. So just worth watching that, because that is far lower than what the markets had anticipated going into last week. Like I said, the broad expectation was for something close to 250 to 400,000. The worst case scenario was expecting up to 500,000, and that is now being confirmed as only 137. So that could see a little bit of a pop to the upside in oil. Definitely worth something just keeping on the radar as we go into the new week. Now, in terms of equities, like I said, didn't really pay attention to the shutdown things, rightly so. We saw a all-time high being reached for both the S&P and the Dow and the Nasdaq before all of them just kind of cooled off a little bit into the close on Friday. But again, we're trading within striking distance of all-time highs, so nothing really major to take away in terms of overall price action. Like I said, the markets rightly shrugged off the shutdown, as they usually do. We just need to be wary that, this time there is some analysts who say it can get a little bit more ugly, but we'll just need to wait it out and see what we get from it. It's not something that I'm looking to trade actively at this stage. It's just way too much of a mess. Now, in terms of the week ahead, just one more thing worth watching that we heard over the weekend. We need to watch the yen as well as the Nikkei at the open, because we actually saw Sane Takaishi, who won the LDP race. Now, she is expected to be voted in as the new premier on the 15th of October and will be Japan's first ever female PM. Now, I read up a little bit about her. Pretty cool lady. She played in as a drummer in a heavy metal band many moons ago. So not the typical type of premier that you would expect. But the main focus for this on the back of prices on Monday will be the yen. The reason for this: she is apparently massive on spending. She's looking to boost output through the roof, massive amounts of spending expected. And with that also obviously comes the risk that the BOJ that the hikes that they are still expecting to make could be delayed a little bit longer. Remember, unlike places like the Fed or any other major central bank, they normally don't follow the government's lead. I mean, there's obviously a lot of speculation about how politicized central banks are, but the bottom line is, if you look at the normal structure, the Fed normally doesn't or shouldn't adjust policy based on what the government wants from them. They should adjust policy based on what the data tells them about what they need to accomplish about their mandate. Where it's a little bit different for the BOJ actually does what the government wants it to do, right? If the government says, hey, we're happy for you to hike, they will hike rates. If the government says, hey, we're happy for you to cut rates, they will cut rates. They basically adjust policy in line with what the government wants. So the fact that she wants a lot of spending, it doesn't mean that hikes are completely off the table. But it could, just like we've seen with the recent LDP nonsense, it basically just pushes the can or kicks the can down the road further down the road for possible hikes. And that obviously is expected to see a little bit of weakness playing out for the yen. So what could we expect? Broad markets right now, or consensus, expect a bit of a pop to the upside at the open for the dollar yen, a bit of a gap. How far will that gap be? I mean, how long is a piece of string? Who knows? I mean, let's watch for those key round numbers like 148, 149. Nobody is exactly sure how far that will go. And the big question then, if we do see that gap to the upside in the dollar yen, and you would also expect to see a gap to the upside in things like the Nikkei as well. If you do see those gaps, do you trade them or do you fade them? Personally, I just don't know yet. For those of you who've watched my analysis for a while, you'll know that I don't like trading the yen on politics or the BOJ, because it can just be real. It can get real messy real quick, which is why I tend to just ignore those assets based on political stuff or the BOJ things. For me personally, I'm just going to wait it out and see how the markets react first. Obviously watching for any additional comments on monetary policy from Takaishi, from Ueda. Those types of things will be important for the week ahead, but it's just not something that I'll be looking to actively trade. Let's wait and see how the markets react. Maybe there could be a fading opportunity. Maybe it's an opportunity to just push the dollar yen even higher. Right now, I just don't know. I don't have confidence trading the yen on the back of political or BOJ things. It's normally just very messy. So just keep that in mind. Definitely worth watching the yen as well as the Nikkei as well as we get into the new week on Monday at the open. Now, apart from that, moving on to the rest of the week ahead, with US data not being released, guys, it's going to be exceptionally boring. It's not going to be very exciting. The one thing that the week is full of is just heaps and heaps of central bank comments. We've got so many FOMC members on the wires next week. That's going to be important to watch, especially in lieu of the Fed meeting minutes that we'll have. Normally the minutes is something that you guys will know, I normally just brush it aside. It's not normally something that moves the markets. This time around, because we don't have the data, maybe there could be a little bit more focus on it. Obviously, there's been a huge divergence in the voting patterns for FOMC members. The discrepancy or divergence between the very big hawks and the very big doves are massive if you look at the recent dot plot. So it could be interesting to just get a little bit of a more structured feel of what exactly the minutes said, how the members voted, why they voted that particular way. But again, we have so many of them on the docket, even just before we get to the minutes. It might not give us anything new. So it's something worth watching, but it's not something that I'll be actively trading at all in the week ahead. In terms of actual decisions, guys, or actual data, I think the most sexy opportunity could actually come from the RBNZ policy decision. That's coming up on Wednesday. Right now, the markets are split on how bold the central bank will be. The official cash rate is currently sitting at 3%, as you guys know, and the broad consensus is already fully pricing in a 25 basis point cut, right down to 2.75%. But the risk is clearly leaning towards the possibility of a larger 50 basis point cut, taking the cash rate down to 2.5%. There's a growing number of analysts that think the RBNZ, might be in store to deliver something a little bit more decisive to just try and boost confidence heading into the Christmas and summer trading period. And the broad argument is that the economy has slowed much faster than what the RBNZ expected. So a bolder move, could help just break that negative momentum as we go into Christmas. The main reason why some are calling for a potential 50 basis point cut. And look, if you take a look at, before we get to the reasons why, if you take a look at rate pricing, just to explain to you how close this is, there's about 35 basis points priced, right? That means that a 25 basis point cut is fully priced in at 100% probability. But because we're trading at 36 basis points, the markets are basically 70% priced towards a 50 basis point cut. Or if you want to put it the other way, there's about a 45% or 45% probability of a 50 basis point cut. Now, if you take a look at recent Reuters polling, I think there was 26 analysts that was polled by Reuters. 15 of them think that the bank will go 25 and 11 of them think 50. So it's not a small component of market analysts that is expecting a 50 basis point cut from the bank this week. Now, the reason why there's this uproar of a call for a 50, the first one is GDP, right? That June quarterly GDP data that showed a contraction of 0.9%, that was far weaker than the RBNZ's expectation of negative 0.3, right? That was 3 times worse than what the RBNZ expected. Apart from that, business sentiment is still very fragile. Firms have been, I would say, slightly more optimistic, to be fair, about the future, but the current activity, it remains sluggish, and it's well below long-run averages. The labor market is the other negative, was mildly positive at plus 0.2, but again, that's not really something to get excited about. And in terms of inflation, policymakers are still they're not fearful that inflation will get this massive reacceleration, right? So the broader thinking among those analysts that are expecting that 50 basis point move is that the RBNZ will want to get the OCR to a more stimulatory level as soon as possible. If you're gonna cut anyway, cut big the first time, front load, if you will, those cuts, and just get some positive momentum going into the year end. So that's the broad expectations. There's also something worth mentioning on the back of that, is the other reason why some are leaning more dovish for a 50 is that the overall the RBNZ committee, the MPC, the Monetary Policy Committee, has also become a little bit more dovish since just 3 months ago. We had the departure, obviously, of one of the more hawkish members. We had Christian Hawkesby. He's leaving in November, so that he might actually give a little bit more weight to the consensus views among the committee as well. So there is shifts in both the MPC. There's been negative data. That's why there's this big call for a possible 50 basis point cut. Now, what does that mean from a tradability point of view for us? Well, it means that whether we get a 25 basis point cut or a 50 basis point cut, both of those things can actually be market moving for the Kiwi. Think about it this way. Let's talk about the 50, because that's a growing view among, like I said, quite a big component of market participants. If we get a 50 basis point cut, it's not fully priced in, right? There's an additional 10 basis points that needs to be priced into the curve in a very short fashion, within seconds, if the bank does follow through with a 50 basis point cut. What could that lead to? Well, obviously, you would expect yields to drift lower, and you would expect the Kiwi to be pressured on the back of that. How could we potentially look to trade something like that? Well, obviously, we would like to pair the Kiwi with something that is strong at the time. If the dollar does regain some composure, I would like to look at a little bit of downside exposure in things like the Kiwi versus the US dollar, maybe back down towards those recent lows around the 57.60. Alternatively, you could look at something like the Aussie Kiwi, but the Aussie has done really well recently with copper prices up, and the RBNZ or the RBA a little bit less eager to cut. I don't think there's a lot of opportunity there to trade that one. Even though we have seen a big move, I feel that move has become a little bit stretched. So I'm not sure whether I would be looking for Aussie Kiwi upside, but it is a possibility. I would rather look for Kiwi dollar downside on that front. The bottom line is, if they do go 50, that could provide us with an opportunity as a scalp trade to short the Kiwi dollar. And alternatively, if they do go for a 25 instead of a 50, even though there are more of a consensus looking for 25, there's still a large component, both on the rate side, as well as the economist side, as well as the analyst side, that is priced and looking for a 50. Meaning that a 25 basis point cut could actually create a hawkish reaction in the Kiwi dollar, where we could look for some upside in the Kiwi. So again, on the back of that, if we come back to the Aussie Kiwi, even though it's had a massive rush to the upside and momentum is obviously still very bullish, we have seen a bit of a breakdown here from the highs. We've traded into some crazy levels of resistance for the pair as well. So if the bank does surprise or cuts with a 25 basis point cut, there could be some short-term opportunity there. I'm not a massive fan of this trade because, again, the Aussie has some positives. There's been good reasons why this pair has been pushing up. Firstly, the RBA has not been as aggressive in cutting rates as many anticipated a few months ago. Copper prices is doing well. Recent data has been more mixed, to be fair, but there's been positive growth expectations coming out of China as well. There's been lots of positive things driving the Aussie higher. Now, a lot of those things we could argue is already in the price at this stage. So again, if it is a 25 cut, we could be looking for some short-term downside in the Aussie Kiwi, just as a pure mean reversion play, nothing more than that. Now, if the dollar, based on shutdown fears, is massively weak going into Wednesday, we could obviously look for some upside opportunities in the Kiwi versus the US dollar as well. But I would be less excited about trading something like that, to be honest. I would feel more comfortable trading something like the Aussie Kiwi to the downside, even though, again, it's also a little bit of a risky play, but I would much rather prefer to do that as opposed to the Kiwi versus the US dollar to the upside. Now, apart from the RBNZ, the other key event that is worth watching will be Friday's Canadian jobs data. Remember, the BOC cut rates at their prior meeting because the economic data is looking pretty poor in Canada right now. Growth is looking bad, labor is looking bad, inflation is remaining sticky. They are in a bit of a stagflation pickle right now. And if you take a look at the trend of the recent data, it's been super ugly, guys. I mean, we shed 40,000 jobs in July, another 65,000 jobs in August, and expectations coming into this week for jobs is at a meager 7,000. So the best play in my opportunity for this would be another big negative surprise in jobs. If we were to get another negative print, that'll be the third consecutive contraction in jobs for Canada in the last 3 months, right? If we get that, that should continue to play out well for the dollar CAD position that I've currently got running. There's one more position on that one. If the jobs data is ugly enough for Canada, I might add some risk to the upside for that dollar CAD trade. Like I mentioned a few weeks ago, if you look at growth differentials, inflation differentials, if you look at the policy dynamics right now, there's very little reason for the CAD to be stronger than the dollar, right? It's very tough to argue for dollar CAD downside. Now, what could change that? Like I mentioned, if the government shutdown continues and it gets aggravated, the markets will not, the dollar won't take kindly to that, right? The dollar could weaken on the back of that, so there is a risk. But if we don't see massive downside from the dollar on the back of the shutdown fears, and we do get very bad Canadian data, I would like to look to add some risk to the upside for the dollar CAD trade. Now, what about the opposite side? What if the jobs data actually comes in super hot for the Canadian dollar? Well, if that happens, I'll be looking to get out of that dollar CAD trade in a hurry. The reason isn't fundamental, right? Like I just mentioned, there's lots of reasons why I think the dollar CAD should be moving up. But if the employment data should come in really, really good, take a look at positioning. Now, keep in mind, this is last week's or 2 weeks back's updated positioning because we didn't get the recent batch due to the government shutdown. So this might have changed, but it's unlikely that it's going to go from very, very stretched short all the way up in a short space of time, right? I would expect it to still be net short. The bottom line is, because the markets, or on the institutional side, because they are this aggressively short on the Canadian dollar, if we were to get some pretty hot data coming out, it could spark a little bit of mean reversion to the upside, and that could see a pretty strong move to the downside for the dollar CAD. Now, the medium-term trader in me might use that push to the downside as an opportunity to buy back the dollar CAD at better levels. But again, the risk there is what happens to the shutdown. We'll need to just gauge that as the week progresses, because if we get to Friday and the shutdown is still in place, I might just give that another week or so. But the bottom line is, I still think there's upside potential for the dollar CAD. We'll just see how that plays out around the data, whether we add more risk or whether we take off risk and then trade it higher from a week or so later. We'll need to wait and see. But that's the broad things we'll be watching this week. So watch out, just as a quick recap, watch out for oil for a possible gap to the upside on the back of the OPEC decision. Watch out for a possible gap to the upside for the dollar yen on the back of the win for Takaishi. In the same breath, also watch out for a possible gap to the upside in the Nikkei. And then for the week ahead, we'll be watching all of those massive amount of Fed speakers. We'll be watching the RBNZ, and we'll be watching the Canadian jobs data as well. One more thing just to add to the RBNZ, which is very important to keep in mind, is this is a statement only meeting. We will not be getting a press conference. Now, that is one of the main reasons why, in my view, the odds are probably skewed more towards a 25 basis point cut as opposed to a 50. That doesn't mean that I want to be trading it ahead of the event, right? If I had a very high conviction, I would have traded this into the event, but I don't have a high conviction because the data was really bad. They could cut rates 50 basis points at a statement only meeting, but I think it's a little bit risky for them to do so. But just keep that caveat in mind for Wednesday. That's one of the things that for me means it's leaning more towards the possibility of a 25 as opposed to a 50. But anyway, that's just a quick rundown of what we have coming up for the week ahead. As always, I hope you guys have a great one. Any questions, don't hesitate to let me know. All right, warm welcome to a brand new week ahead, everyone. I hope everyone had a great weekend and rested well. Let's quickly take a look at what we have in store for us for the week ahead. I mean, last week was just so massively complicated by the US government shutdown. You know, that completely complicated things. It meant that we didn't get any of those key US data points, especially the likes of the NFP that we were waiting for. It also means that it complicates things for both the markets as well as the Federal Reserve. Remember, these guys, they need the employment data in order to make up their mind about what they have to do about interest rate policy. So the fact that we didn't get those key economic data points, especially NFP, it just super complicates everything. Now, when it comes to government shutdowns, usually they're short-lived and the markets don't really pay much attention to them. And to be fair, if you take a look at how markets traded across the board last week, I would say for the most part, markets have been able to just, push it aside and didn't really pay much attention to it. There wasn't a lot of market reaction on the back of the shutdown. But there are a few analysts who argue that, maybe this time could be different. I mean, at the moment, if you take a look at US politics, the polarity and massive division that we have between the two political parties, it's grown to crazy intense levels, right? And currently the main opposition or main issue that they have with the shutdown is arguments about healthcare subsidies. That's one of the major stumbling blocks at this stage. And normally when you have these shutdowns, there's talks of potentially furloughing federal employees. But right now, the Trump administration is they basically coming out talking about straight up layoffs for many thousands of federal employees. So even though markets normally rightly look through these types of situations, and I really do hope that it's a short-lived thing, even though that's normally the case,